course, our macro views will vary by region, and even in some cases by country. While the global economy is a major driver of the economy in all countries, different regions do have different dynamics. So you need to vary your view by region or even country. For example, while the US economy in the US has been pretty good the last few years, it has been notably weaker in Europe. That said, Lyrical manages a US-only stock portfolio for the Alliance Trust, and so the vast majority of what impacts our stocks is what is happening there. But even in a US portfolio, about 30% of company revenues are from outside the US. A little over 10% is from Europe, a bit less than 10% is from Asia, and about 5% is from the rest of the world. So even in a US-only portfolio, a regional macro understanding is needed.
Our macro view does tend to vary country by country, given that different countries are operating at different cycles at different times. So if you think about the North America sort of complex, the United States and things like that, a lot of folks were prepared for a recession. They're sort of expecting one to come, had slowed down sort of consumption. You've seen sort of the balance sheets in pretty good shape. And that recession actually hadn't necessarily come to fruition. So consumers are in healthy shape. Corporates are in healthy shape, although things are decelerating. You go over to Europe. Europe is slowing down and decelerating. Some places like the UK actually has had a couple of negative GDP prints. So they are technically in recession. So we do see things slowing there. And then other parts of the world, Brazil, India, you've seen a reacceleration, a big infrastructure boom in India, really strong growth coming out of Brazil. And you juxtapose that to what you're seeing in like a China, where things continue to sort of be slow and sort of malaise going off of a lot of those property related issues within their finance industry.
Macro assumptions don't materially impact our portfolio. Macro is really hard to get right, maybe even impossible. Oh, and even when you get the macro right, the markets don't always react how you expect them to. Just think about 2020, the year COVID erupted and shut down most of the global economy. The S&P 500 that year gained over 18%, which is about double its long-term average. Go try to make sense out of that. At Lyrical, we are bottom-up investors. We don't make guesses about the macroeconomy. Instead, we scour our universe of stocks and look for resilient businesses at cheap prices. By owning resilient businesses, our companies are able to bounce back even when the economy takes a dip. And by buying them at cheap prices, we have a large margin of safety, so the business could still be worth more than we paid for it, even if things don't go well. In the end, when it comes to stocks, we believe micro beats macro.
In terms of our macro assumptions, we're fundamental bottom-up stock pickers, so the individual idiosyncratic sort of things that are going on with the company is what drives that decision. We have to be macro aware, because even if you're a consumer staples company selling toothpaste, as a matter of fact, or for example, you have that environment where the consumer could be slowing down, they could be trading down, they could be accepting less price increases, or the stocks may be too expensive in that one particular area. Because very people are anticipating that you need that safety net, if you will, for a recession. So we do have to take that into consideration when we're making these fundamental stock calls.
Oh wow, that's always a tough question. It's a bit like asking, who's your favorite child? At Lyrical, we only construct concentrated portfolios. Only our favorite investments make it into the portfolio. We are excited about each one of our stocks, or they wouldn't be there. On the other hand, to be fair, no stock is perfect, and we don't get every investment right. There are always concerns to monitor. At the moment, a few of our exciting investments would be United Rentals, which is one of our largest positions, Fidelity National Information Services, which is one of our newest positions, and Ameriprise and AirCap, which are two of our longest held positions. While we were excited about these stocks, I want to re-emphasize, we could just as easily mention several others we are just as excited about.
In terms of what we're excited about in the portfolio right now, I think within the technology space, you've seen a lot of these companies come off of a multi-year downturn. After the COVID bubble sort of burst, a lot of these technology, e-commerce and communication services types of names, they're coming off of a bottom. There's sort of a natural reacceleration that's happening. And then you have AI, really fueling that acceleration on top of that, accelerating that recovery even further. Outside of the technology space, we really like things within the energy space. I think that those markets are fairly consolidated. The producers are still staying fairly rational in terms of the amount of supply that's being put on. And demand is still coming through, stronger than folks would have expected on a longer term basis. So we're very constructive there as well. So an interesting juxtaposition between those two sort of things on the energy side and on the technology side within the portfolios.
What will happen if we're wrong about the economy? Well, I've been in this profession for about 30 years, and I don't think I've ever been right about the economy. So we have not needed to be right about the economy for our portfolio to succeed. Yes, in the short run, our returns should be higher in a good economy and lower in a bad one. But over the long run, we have found that getting the company right is much more important than getting the economy right. With our portfolio characteristics, we should be positioned to do well in any environment. First, our portfolio company earnings have grown faster than the market. Second, those earnings have been less economically sensitive than the market. So in past downturns like the global financial crisis in 2008 or the COVID shutdowns of 2020, the earnings of our portfolio companies decline less. And lastly, but most importantly, the valuation of our companies is much cheaper than the market. That powerful combination should work over the long run, whatever the economy does.
If we're wrong about sort of the economic outlook, one of the things that we always try to strive for is to prepare, not necessarily predict outcomes. When you predict outcomes, you cement your mentality in terms of what you think is or what you believe is going to happen, versus if you're preparing for different outcomes, as the data comes in and adjusts sort of your views of what those outcomes would be, you adjust sort of your mindset and your portfolio accordingly. And that's really what we're trying to do, is incorporate that new data, because quite frankly, on a 5-year basis, you don't know what exactly is coming down the road. 5 years ago, we didn't know that a global pandemic was going to come through. We didn't know that the US and China were going to go into sort of a trade war. We didn't know a hot war in Europe was going to start. We didn't know that the Middle East was going to have a conflict as well. So those are things that you need to be prepared for, not necessarily predict are going to happen.